Hello traders, I want to welcome you today to these Forex classes, probably for beginners. So if you know you're a beginner, just welcome, listen as I'm going to guide you in what is trading, what is Forex trading. So let's start. Beginner Forex trading notes. What is Forex trading? Definition. Forex trading, that is foreign exchange, involved in buying one currency while selling another simultaneously. It operates in currency pairs. For example, Euro USD. So EUR USD means Euro USD. Euro USD is the currency used in Europe, and USD is the currency used in United States. For example, if you think the euro will strengthen against US dollar, then you buy Euro USD. If correct, you profit when Euro appreciates relative to US dollar. So if you predict that Euro is gonna gain value, then you will buy Euro USD. That is why when it goes your direction, then you get the profits. Okay, so for example, this one will help us understand exactly what does that mean. So for example, understanding the currency pairs. So base currency, the first currency is in the pair. So the base currency is the first currency in the pair. For example, we said at this point Euro USD. So the first currency is Euro. So EUR, this one EUR is the first currency is the first currency. So that is what we call it the base currency. Then the next one is the quote currency, the second currency. So the quote currency is the second currency. This one, USD. So USD is our quote currency. So we have Euro USD. One is the base currency and the other one is the quote currency. The base currency is the one in the left hand side and the quote currency is the one in the right hand side. I'm going to explain more and more about this. Now let's go on. So we go and see major pairs. We have different types of pairs in Forex markets, okay? We have different types of pairs and we need to understand this because of volatility in the markets. This includes USD. So major currency pairs is what we call, it includes the USD. For example, Euro USD, GBP USD, USD JPY, those are the major currency pairs. Those are the major currency pairs. These are two, but we have so many major currency pairs. That is the one we are going to trade because of their volatility. When I say volatility, is that these currency pairs usually these currency pairs is good for traders to trade. They are volatile or they move very fast in the market. When it comes to movement in the market, it's move fast because of the transactions that's happening in that countries. So I want you to remember that in Forex market, this is the transactions that happening across the world. Now we come to the cross pairs do not include the USD. So the cross pairs do not include the USD. For example, EUR, GBP. So this is Euro versus GBP. Just remember the base currency and the quote currency. This one is base currency, then this one is quote currency. Always, base currency has more value than the quote currency because, for example, 1 euro is equals to a certain amount of GBP. So 1 euro is equals to 1 point something US dollar, meaning the euro is the one with more value than the USD. Now we come to the exotic currency pairs. This one, exotic currency pairs, include the one major currency pair and a smaller or emerging market currency. For example, USD versus KES or USD versus Kenyan shilling. So this one, USD is from major currency pairs, while the Kenyan shilling is from the minor or the smaller country the emerging countries. So that is what it means. Make sure you understand what is exactly happening in these markets. So we have this one, what is the PEEP? These are the basic terminologies that is found in Forex markets. For example, we come to this point, the definitions. So the PEEP A pip is the percentage in point. So percentage in point, that is PIP, that is a pip, measures the smallest price movement in a currency pair. So it's a smallest movement. For example, it's decimals. So once the price changes its value, it's changing using the decimals. So decimal points are the one that is we minus. For example, Euro USD. For Euro USD moving from 1.1000 to 1.1010. It moved for 10 pips. So for example, you said this one minus this one. So 1.1010 minus this one. So you get 10 pips. Okay. That is exactly what does that mean. For example, again, we say USD versus Kenyan shilling. So moving from 140 to 140.5 to 140.6. So we say 140.6 minus 140.5. It moves for 10 pips. So that is what we call the pips in Forex trading. For example, when we come to the next terminology, that is what is a lot size. So lot size is the volume or size of your trade. It's volume and or size of your trade. So we have different types of volume. For example, the standard lot, we have the mean lot, mini lot, and then the micro lot. When we come to this one as an example, if you trade one standard lot on Euro USD and the price moves by 1 pip, the value is 10 10 US dollars per pip. So, for example, you place your trade, you want to buy a certain currency pair, for example, Euro USD. So, 1 pip, only 1 pip is equal to $10. So, you will get a profit of $10 in every 1 pip. But for example, someone else can trade on remember this is one lot. Someone can trade on with 0.09, 0.08, or 0.01. So when you come to 0.01, you will now get as $1 in 1 pip. So I want you to understand that. So make sure you understand that. So what is the candlesticks? So we have the candlestick. Candlestick is what is commonly used in forex trading, analysis, and also identifying the direction of the market, doing the analysis on where the direction of the market is going, and all the analysis that's happening in forex trading. So the candlestick plays a lot, and it's one of the best way of analyzing the markets. We have we have bar chart, we have also the line chart, which can represent the market, but the candlestick one are the one that we are using. So candlestick shows the price movement over a time period. For example, 1 hour, 1 day. So in a candlestick usually represent a price over and time. So it is representing price and time. So we have the open, we have the close, we have high and low of the candlestick. So we come to this point. This is the candlesticks. So this is the green candlestick. The green candlestick means that the price is going up, and the red candlestick means that the price is going down. So I want you to imagine that, for example, we want to buy. If we want to buy, then we are looking for the green candlesticks. So the green candlesticks. So open, this is the open of the green candle, then this is the close. So for example, let's say the previous time, let's say it's 10 p.m. So at 10 p.m., the candlestick started forming. So it starts from this point. But first of all, there is fluctuation in the market. So the price can move up or down. So at first place, the price can move down up to this point. So this is where we call it the lowest point where the candlestick reached during that specific period. When the price goes back, the price will be pushed and the price will go up to this point. So at first, the price will go up to the highest point, then the sellers will push the price up to this point. So this is the closing price during that specific time. For example, after 1 hour, after 1 minute, or after any other given minute. So remember, this is going up. This is the open, this is the close, this is the highest point the price reached during that specific time. When we come to the bearish candlestick, this one, so the price is going down. So the previous candlestick was formed maybe at around this point. Now the price is going down. So at this point, this is the open of the candlestick. It is open because we are selling. Selling is we are going down. Buying, we are going up. So at this point, we are selling. Selling is going down. We anticipate the price to drop, to go down. So at this point, we have the open. So this is where the price will start. Then the buyers will try to push the price up to this point, but the sellers will push the price downwards. So that is why this is what we call the highest point the price reached during that specific time. Then the price went up to this point. It closes at this point, but it has went before up to this point. But the opposing forces trying to oppose back the price up to this point. So that is why we say that is the close, this is the low, or this is the low, this is the lowest price point where the price reached during that specific time, the close of that red candlestick, and this one is the open of that red candlestick. So please make sure you understand that. We have the participants who are these people who are participating in the market. So we have different people who are participating in the market. Please remember to subscribe, like, and comment. Bless me with a subscribe, guys, if you enjoyed that. So, for example, at this point, we are going to the market participants. So, at first, we have the retail traders. Retail traders, individuals trading small accounts. For example, if you are trading, for example, $500, $10, $20, $1,000, you are a retailer. So retailers are those individuals who are trading their small amount of capital, who have small capitals. So those are the people who are trading. We call them retail traders. For 1,000 USD, 2,000, like that one. So that are the retail traders. For example, we have the institutional traders. So these are the bank, hedge funds, and etc. So these are the institutional traders, hedge funds, companies, yeah, etc. So they are also trading in forex market. Okay. Yeah. So when we go to the third one, this is the central banks influence currency values through monetary policies. So the central bank can decide to um, increase the value of the price by considering the policies of the monetary policies. So that is why the value of a certain currency of a country's currency can be changed or can be influenced by the central bank to change its value. That is one of the reasons why the price, these are the participants of the market. Then also we have the government, so engage in currency interventions. So if in case, for example, a certain government saw that the price is going to reduce in value, then they are going to intervene. They are going to try to do their best so that they can return their price into line. So they will not want their price to depreciate or to lose value. So they will try and intervene and protect their currency value. So remember that the currencies or the markets, the currency pairs that we are trading, for example, one, the euro and US dollar. So the Europe countries will try to prevent its currency, the currency value of their own currency, and the United States will be doing the best to prevent their currency from being undervalued. So that is how the government intervene and make their prices, their currencies do that. So, for example, this is the best thing that you need to understand as a beginner. So, at this point, we must know who are buyers and sellers in the Forex market. I want you to understand this and don't skip this if you want to be successful in Forex. So, not all people can tell you this. So, understanding buyers or bullish. For example, buyers are participants who believe the price of a currency pair will rise. So they open buy position, also called going long, to profit from uptrend price movement. So for example, if you trust, so okay, this is an example. If traders believe that euro will strengthen against the US dollar, they buy euro USD. For example, if you trust or if you believe that a certain value, for example, you want to buy a piece of land. So, for example, you have checked a certain place and see that this place in near future, the price of land will increase. So you will develop that interest and you will buy a land at that specific point area. So after buying a land at that area, then you are going after that. In future, you are going to sell that price, that land at a different price. So making profits. So that is how you anticipate whether a certain currency pair will increase in value or will decrease in value. So for example, if you anticipate that this currency pair will lose value, then you are going to buy, to sell. Okay, so that is how it is. I'm still explaining that in my next videos. So for example, understanding sellers. So sellers are participants who believe the price of a currency pair will fall. So they open sell positions, also called going short, to profit from downtrend movement. So example, a trader expects the USD to strengthen against the euro. So we have the euro USD. So previously we said that we expect the euro to gain in value so that we can buy. But now at this point we want to sell. So if we want to sell now, we are expecting or we are anticipating the USD to strengthen in value. So this is now opposite. Last time we were saying the euro will strengthen, but now we are saying that the USD will strengthen. So we are going to sell. Okay, so how buyers and sellers move in the market, supply and demand. So what is your demand? What's the demand? What's the supply? So supply and demand. So the price of currency changes, the price of currency pair changes based on the balance between buyers and sellers. So there must be buyers and also sellers in the market. So there is no day the buyers will be only people in the market, or there will be no day where the sellers are not in the market, because where there must be a buyer, then there must be a seller. For example, for you, if you want to sell a land, there must be someone who will be buying on the other side. So that's how you are going to buy, or that's where you are going to sell. So that is how exactly it is. So for example, if you want to sell also your piece of land, then you must see the demand. Okay, so you must balance the demand and the supply. Okay, maybe you want to buy a land, or maybe you want to sell something, then buyers and sellers must be equal. So if there are more buyers than sellers, demand increases. So this is the best thing that you need to understand, because this one will help you understand exactly what's happening in the market. So before we go into the charts, this is the best knowledge that you need to understand first. So if there are more buyers than sellers, demand increases. So as like usually in a business, if there are more buyers than sellers, then the sellers will feel like now they are owning the market. Okay, if there are more buyers than sellers, demand increases and the price rises. Okay, so the price rises if the buyers are more than the sellers. uh, at this point, on the other hand, if there are more sellers than buyers, the supply increases and the price falls. That is exactly what's happening in a business. So this is exactly what's happening in Forex trading. Most of the people usually complicate things in Forex, but it's simple. You need to understand this basic thing first before you go into the charts. Okay, so at the second point, we are the key influence on the market directions. So we have the influences that causes the market direction to go into a certain point. At first, we have the positive economic news about the country increased demand for its currency, pushing its value high. For example, let's say a certain currency announces that the GDP, that is gross domestic product, increased during a certain year. So if the GDP increased, then meaning that country is doing well economically. So that one will bolster the currency pair of that country. The economy, meaning the economy of that country is doing good. So the price of the currency value of that country will increase. Okay, so that is how it is exactly. So central bank policies, for example, higher interest rate in the US might attract buyers to USD, increasing its value. So for example, the US said that they are increasing their interest rate maybe from 10 to 20%. So most of the people will want to on US dollar because they are going to get more interest at the end of it. The value of the dollar will increase in terms of interest rate. That's why most of the people will want to hold the USD, and thus holding that USD will increase value because most of the people have trust in that currency pair. So market sentiment, investors are optimistic. Okay, they may buy riskier currencies, causing those currencies to rise. For example, I want to use a very simple example. Also, I can use a land, maybe, or something else. For example, you trust, or you trust that something will improve in future. Okay, you trust that something will improve in future. So because most of the people, even if that thing is not working good, but most of the people can go and get that thing and modify it, make it good, look good, then later this one will be expensive. So that is how the market sentiment say how what the market sentiment explaining. So that is how it is. For example, we have this example of price movement. So scenario one, price moves up, bullish market. Okay. So if the price is moving up, we refer that as the bullish market. And if the price is, yeah, buyers are confident that Euro USD will rise. They enter buy positions, increase demand for Euro. The price, for example, the price of Euro USD rises, for example, from 1 to 1.100 to 1.1020. That is 20 pips, okay? So as we had seen how we can calculate the number of pips, we minus this one and to this one. So we take this, we minus, we less this one. Then we get the 20 pips. The second scenario, price moves down, that is bearish market. So we said when the price is moving up, we call it bullish market. And when the price is moving down, we call it the bearish market. So sellers believe Euro USD will fall. So they open sell positions, increasing supply or for euro in the market. So the price in Euro USD drops, for example, from 1.100 to 1.09098, that is 20 pips down. So please make sure that you interpret this well so that you can understand that. So why do buyers and sellers disagree? Different participants interpret information differently, okay? So a buyer might see a strong GDP data as a reason to go long. A seller might focus on rising unemployment as the reason to go short. Okay, so that is how it is. This is my first class, guys. With the first beginning class to Forex trading. Please subscribe. Make sure that you ask any question under the comment section. Kindly join my groups, join my Telegram group, follow, subscribe, and anything that you feel like you want to ask, just ask any question at that point. So welcome, guys, and I wish you all the best, all the successes as you are going to proceed with your trading journey. Have a lovely trading experience.